Deutsche Bank is desperately trying to save itself. So over the last week, there's been reports coming out, whether it's from the Wall Street Journal or elsewhere. I have one up from Reuters. I have 5 articles I found for this short little update for you guys. Either they're recent ones in the last week or they're going back from April. There's actually a website called wallstreetonparade.com, and they do a really good job from Pam Martins and Russ Martins covering specifically Deutsche Bank. They have a really good article on Deutsche Bank from April 17th of 2019 talking about how Deutsche Bank received $354 billion from that Ron Paul audit, the secret bailout that the Federal Reserve gave to foreign banks, foreign governments, foreign central banks, foreign corporations. Deutsche Bank, I believe, was the 9th largest list of the borrowers that we got in the GAO audit. It's talked about in this April 17th, 2019 article. So Deutsche Bank is planning on, let me take a look at the Zero Hedge article. They are planning on exiting equities in a big restructuring. The restructuring number has changed, I believe, last week. It was initially projected at about 1/3 of their market cap, so around 5 billion or 6 billion euros, and their market cap right now, as of July 5th, is around 16.6 billion on their US shares on the New York Stock Exchange, which is their ADR, I guess. The stock has actually rallied quite a bit since May and June. The stock was below 7 and it was looking like it was going to totally collapse. The chart is just absolutely bad since April 17th, and then all of a sudden, like, remember what I talked about with those mysterious manipulation rallies in Deutsche Bank? Remember I showed you those the chart like last week or the week before? I did a video going through with technical analysis showing that the falling knives were purchased. And no professional trader who's managing other people's money will take the risk of catching falling knives like that. And the Deutsche Bank chart had over 20 falling knives that were bought. And Deutsche Bank's stock chart rallied pretty strongly since May and June. It's up to over $8 a share again. However, if I was managing money, and this is not financial advice, I'd be looking to buy puts out of the money on those. Do you like the economic cartoon I have? I looked for it and found a good one. I found the SOS, baby. That's the Deutsche Bank logo if you're not familiar. I could not find a good hedge eye cartoon with that, but that is money, that economic cartoon. So Deutsche Bank is doing what predictably a company would do to try to delay bankruptcy. So if you're trying to delay bankruptcy, if you're a company, normally you're going to sell assets, you're going to fire employees, you're going to cut expenses, you're going to sell what you can to raise cash to delay probably the inevitable. It looks like that they are going to the bad bank model, but the bad bank model, according to the Zero Hedge article, is only projected to be, what, 78 billion? 74 billion bad bank. 74 billion euros bad bank. But as I've discussed at length about Deutsche Bank, and lots of Wall Street people are well aware of this, some of them admit it publicly, some of them will not, Deutsche Bank's derivatives are nowhere near this level for the bad bank, okay? Let's put Deutsche Bank's derivatives book in perspective of how big, how grotesque, how ridiculous their derivatives position is. And all the other Wall Street banks have big derivatives positions, but Deutsche Bank has mishandled their derivatives position, over-the-counter derivatives position, even worse than the other banks, at least as far as we know of. Now, we don't know if these other banks are having derivatives failures, but we do know that Deutsche Bank has had a problem with them in the past, as evidenced by the Ron Paul partial Federal Reserve audit that we got, how much money Deutsche Bank was given. And I'll attach a link to that article if you want to take a look, from Wall Street on Parade, which has a link to the audit and talking about it more. So Deutsche Bank's derivatives. Deutsche Bank's derivatives are down. This is funny. This is from the Wall Street Parade article from April, that their derivatives book is actually down now to $49 trillion. It was higher than that. So in their 2018 annual report, their derivatives are claimed to be down to only, in air quotes, $49 trillion in derivatives. So let's put that total derivative amount in perspective. So that is more than 3 times larger than the total GDP of the European Union, And that is well over 10 times larger than the total GDP for Germany. So they can't, the German taxpayer and, the German taxpayer cannot exactly bail out all the problems with Deutsche Bank. This is like a central bank level problem. This is a problem with currency swaps that only central banks with currency swaps on their keyboards sending $1 trillion here every couple months or something like that can solve, at least temporarily. That is how bad Deutsche Bank is. So maybe in the short term, Deutsche Bank will rally. If I was, again, this is not financial advice, but the more and more it rallies, the more and more, if I was managing other people's money, I would be looking to buy out of the money puts. I have other articles here as well from Deutsche Bank. There is, again, really good analysis on the Wall Street on Parade articles. They have a couple really good ones. One that just came out 2 days ago as well. Let me see here. Let me pull it up. Okay, so the Fed and Wall Street have their worry beads out over Deutsche Bank's bad bank idea. According to press reports around the globe, there's going to be a hot confab this Sunday by the board of Deutsche Bank that will focus on the potential to create a so-called bad bank to hold some of Deutsche Bank's toxic assets, along with discussions of cutting 15,000 to 20,000 employees from the payroll, meaning as many as 1 out of every 5 employees could get the axe. A big part of the job losses will hit Manhattan, where Deutsche Bank has a heavy presence on Wall Street, which it plans to severely pare back. Here's a short version on why the bank is contemplating these radical moves. Deutsche Bank has reported losses in 3 of the last 4 years. Its share price has lost 90% of its value since February of 2007. As of the close of trading on Wednesday, Deutsche Bank had $16.14 billion in common equity versus equity value versus 49 trillion notional face amount in derivatives. It's had 4 different CEOs in just over 4 years. That's a lot. Big red flag. It can't find a merger partner, and its home country of Germany, unlike the, quote, throw money at the Wall Street mega banks, end quote, U.S. government doesn't seem inclined to hand a lifeline to Deutsche Bank's sinking hulk. Well, I think the German taxpayer in one of these articles talked about how the German taxpayer had bailed out some German banks for about $70 billion, but that the U.S. had given way more than that. And that's because I guess Germany and the European Union and the European Central Bank are expecting the Fed to increase, either maintain and or increase those currency swap lines. And some people like the Jeffrey Snyder loyalists out there who are like, the currency swaps don't matter. The currency swaps are what paper over the losses, okay? They're the biggest liquidity pump that I know of, because it's the only thing that can happen where basically an interest-free loan that can be canceled later, $1 trillion or more, can be immediately sent through a keyboard currency swap line. The central bank claims it's not a liability. The Federal Reserve does. The Federal Reserve claims that it has collateral on it, and then miraculously the loan is canceled. Okay, this is how the bailout program works now. The currency swaps have gotten much, much larger. Central bank to central bank currency swaps. So if you want to read more of the article, I could read more of this article, but if you want to read it more, I'll just attach links to it. I'm sure most of you, I get listener complaints when I read entire articles on here. So sometimes I'll read full articles and sometimes I won't. But there is some really good research out about this. The bottom line is that the German taxpayer is not going to bail out Deutsche Bank. The restructuring plan may temporarily help things. If Deutsche Bank is going to, if the share price is going to continue higher, I would not be surprised if they do, say if they can get the share price back to 9 or 10, if they can do a capital raise, like a pretty big one, a good chunk of their market cap, I would not be surprised. But there's people out there with the over-the-counter derivatives, and they incorrectly think that the banks, the large banks, are telling the truth about their derivatives books. And let me explain. Nomi Prinz has talked about this, and Nomi Prinz was very high up in Goldman Sachs and Bear Stearns, and she's one of the few people who is actually honest, who worked on Wall Street at that high level, and is willing to talk about derivatives books and stuff. So I encourage you to go and listen to her interviews about this. I've interviewed her in the past about this. But basically, though, if you try to say that the banks are at risk with their over-the-counter derivatives books, that are trillions, many trillions of dollars and much larger than the bank itself, the banks will call you a liar. The bankers will, and a lot of mainstream financial people and a lot of people in the mainstream media and a lot of people working on Wall Street will call you a liar and a conspiracy theorist. And they will say that it's no big deal, that the net derivatives exposure, it all nets out. The problem with that is the gross size of all the over-the-counter derivatives, and the Bank of International Settlements has kept lowering the estimates. It used to be over a quadrillion in total gross over-the-counter derivatives. The problem with saying everything nets out is we have evidence that it has not all netted out, that we've had derivatives fires that have been put out in 2008 and 9, and also there was problems with Cyprus, there was problems in Greece over derivatives that caused problems for European banks and elsewhere. Look at MF Global. MF Global did some big bets on that and blew up. So there's been examples of this that really no one wants to talk about too much anymore, especially in the mainstream media, especially in the mainstream financial media. But the gross exposure. So all that really has to happen when you're that when you have that much over-the-counter derivatives exposure, and you only, as Deutsche Bank has, only have a $16 billion worth of equity. So yes, they can sell some assets, but a lot of their assets they may list on their balance sheet may also not be good collateral. They may be rehypothecated. They may be listing as assets their customers' deposits for some of the things, some of their customers' assets as their own. So the $16 billion market cap that Deutsche Bank has, it is nowhere near enough to cover any losses if one of those big derivatives positions that supposedly netted out goes bad. Okay, all it takes is one or two big ones to go bad. And here's the problem, and this is why Bear Stearns and Lehman Brothers failed. So Bear Stearns, I believe, was leveraged 60 to 1. And when you're leveraged 60 to 1, and this is officially, this is not counting how all the banks, all the large banks all cheat. All the large banks have enormous off-balance sheet stuff, okay? The average banking analyst on Wall Street, the guys who are getting paid six figures to do this research, most of them don't cover any of this stuff. They don't look at any of the off-balance sheet stuff. So the banks are very clever with marketing games. Who do you think Enron learned to move all that off-balance sheet stuff from? Who do you think they learned it from? They learned it from all the Wall Street banks who they were paying fees to, consulting fees and other stuff fees to park the cash. And the Wall Street banks were the ones who taught Enron how to do it, okay? Enron got in trouble because they had tons and tons of off-balance sheet stuff that was being hidden. And Jim Chanos noticed it. Well, guess who they learned it from? They learned it from the Wall Street banks. So the Wall Street banks, the large ones, all have a lot of off-balance sheet stuff. A lot. And unless this is your full-time job and you know what to look for and you can speak the banker speak, you're not going to know what to look for on that stuff. And Bear Stearns got up to 60 to 1 leverage, and that was just on-balance sheet. Off-balance sheet, it was even worse. Same thing with Lehman Brothers. So Bear Stearns, all it took when they were leveraged, the bank's balance sheet was leveraged 60 to 1. All it took for Bear Stearns to become insolvent was not even a 2% drop in their assets. It was 1.5, a little over 1.5. And for Lehman Brothers, they were leveraged 40 to 1. It only took a 2.5% drop. So 40 times 2.5 is, what, 100. So it only took a 2.5% drop to wipe Lehman Brothers out, meaning they were insolvent too. So Deutsche Bank's been fined for all these market manipulations in LIBOR and gold and silver and all these others. And the bank, it should have been dead a long time ago. But I think what will happen, this is my educated guess, is eventually Deutsche Bank equity, their share price will go to zero. I don't know, maybe in a couple years. Because it seems they've delayed this thing so long, but eventually it does go down. The manipulation fails at key overhead resistance levels, and the shares just start being sold more. And then eventually Deutsche Bank shares will go to zero. The bank will be restructured. And I think the only way then that the counterparties for Deutsche Bank that are holding some of these toxic derivative garbage stuff, the only way then is that the central banks, either the European Central Bank, the Federal Reserve, maybe both, will have to come up with some type of new scheme, some type of rule change plan to say that even though Deutsche Bank failed, we as central banks, to prevent systemic collapse, to prevent another financial crisis, more like delay another financial crisis, are going to guarantee their derivatives exposure, their derivatives contracts. So that's my educated guess. I've been saying it now for the last couple months about what will happen with Deutsche Bank, is that the equity, the share price of Deutsche Bank will go to zero. They're already insolvent. Most people just don't know this yet. Okay, I just blocked that guy. That was ridiculous. This guy he was just writing comments about Ripple every like couple seconds in the comment section. Just ridiculous. Oh, man. Just don't want to... Look, man. Free market, all for cryptocurrencies. Just don't go pumping your stuff here in the comment section. If you have a well-researched argument or a good take, good opinion, go ahead and present it. Don't just say that garbage. Okay, I'm looking at listener questions and comments. The bad bank thing... We would have to know the real size of how much toxic garbage is going in there. The 79 billion or whatever, the billion euro amount or whatever they're saying, that's nowhere near enough. So if they're really going to stash trillions and trillions and trillions in there, and the central banks, the Fed and the Federal Reserve and the ECB are going to guarantee the toxic garbage in the new bad bank, then that could calm down counterparty risk. But it's very common knowledge on Wall Street about the derivatives exposure and the counterparty risk for most of these pretty much all of these European banks, and Deutsche Bank was considered the worst. Precious Metal Update says this is a great channel. Thank you. A lot of hard work. Blood, sweat, and tears, man. And also relentless practice and learning to get better. Danny says this bank is a looming disaster and its collapse is inevitable. Yeah, it's a question of when and not if it will collapse and how it will be handled. Okay? So I haven't seen anyone else mention my theory, which is that the equity, the share price will go to zero, and then the central banks will come in and step in and guarantee and announce with a big press release that they are guaranteeing the derivatives. So the counterparties, the other banks to Deutsche Bank that are holding these derivatives bets will be made whole, or at least like partially made whole. So the people out there with the saying that the net exposure on derivatives, it's the gross exposure, the massive size, that is the danger part. Because when you're looking at a quadrillion dollars in derivatives, all it takes is a couple bad derivatives positions to collapse one or two banks, and then those counterparties, they all start falling like dominoes. And this is why in the Chinese banking system, sorry to get a little off tangent here, but this is why in the Chinese banking system, there's a big panic. And everyone is saying that Baoshan Bank was too small. Well, you're starting to see a lot of the same problems escalate now in the Chinese banking system too. So yes, Baoshan Bank was small, but the other banks are not trusting each other anymore. And the interbank lending has slowed down, and the interest rates for the banks to borrow from each other has spiked a lot. And this is always a warning sign. When the banks stop trusting each other, it's always a big red flag. And you see these in like the interbank lending rates, whether it's in the US or Europe, London or Hong Kong or Shanghai. Hey, thank you for the $5 super chat, GP100. I appreciate it. Carl asked, "Will douche bank?" I did see a funny economic cartoon calling them douche bank, but it also mentioned Trump, so I went with this one instead. I think the SOS was a better choice, less political. Domino hitting other banks. Yes. Yes, Deutsche Bank will be a domino hitting other banks. However, and we might not find out about this, is the central banks, like the European Central Bank, and this is why they're not going to abandon QE. Because, number one, the European governments have to borrow more and more money at cheaper and cheaper rates. They can't afford it, so they have to manipulate interest rates lower in Europe. And number two, the corporations in Europe have a lot of financial problems. They cannot afford higher interest rates. And same thing with European banks. So we may not find out that another European bank was close to failure. We may not find out until it's either too late or close to too late. And Europe seems more intent on going towards, that Cyprus model, with not only negative interest rate policy, where they're charging borrowers to deposit money there, to dock their cash there, but also a ton of negative yielding debt. But they could also have plans for bail-ins and bailouts, a mix of these things, which would be just a worst case scenario. I'm looking through questions and comments. I have not read Too Big to Fail by Sorkin. Is that the guy on CNBC, the biased one from New York Times? He seems to be pretty mainstream. Y user says, interesting theory. He wonders if more bailouts might be politically unpalatable. Well, this is why central banks have gone to the currency swap, backdoor bailout, covert quantitative easing, or QE model, is because bailouts specifically announcing bailouts are very politically unpalatable. Are you kidding? Here in the United States, there's so many people who are socialists now, so many people who hate capitalism, that if they announced on TV that these banks were going to get big bailouts again, you would start to see people coming with pitchforks and torches here to the DC metro area. I'm reading Christopher Myers' book about 100 baggers, how to find 100 bag stocks. So I think that's a good audiobook. Okay, well, that's pretty much it for this short little video and update. I will attach links to these articles. There's some really good ones out there if you want to go more in depth. There's a bunch of details about Deutsche Bank's restructuring plan. You don't really, unless you're trying to trade the shares up and down and make volatility trades, again, not financial advice, but if you're trying to trade these rallies, unless you're doing that, you don't need to know all the specific details. You don't need to know all the specific details at all. There's nothing in their restructuring plan whatsoever, whether it's firing 20,000 employees or selling off this assets to one bank or this assets off to or these assets off to another bank. There's nothing in their restructuring plan that can solve their derivatives problem. Absolutely nothing. That is a massive central bank level problem. It's like in the Marvel Cinematic Universe, how there's like lower street level villains, and then there's like cosmic level villains that only the Avengers or other very powerful characters can fight. And this problem, the Deutsche Bank problem, and the over-the-counter derivatives problem, is something that only central banks can handle. Okay, governments, well, the People's Bank of China is going to print tons of RMB to try to deal with the Chinese banking system, but it is still a central bank level problem, because the People's Bank of China will be the one printing the money and inflating away the RMB debt. Okay, guys, well, that's it for now. I just wanted to do the short update for you guys. Hopefully you enjoyed it, and if you want to read more, I'll put the links to the articles in the information section. Bye for now.